Usually, when a bank's profit margin expands, their net income just naturally follows right along with it.
Right. It's basically financial physics at that point.
Exactly. But today, we are looking at a really fascinating contradiction over at Heritage Financial. I mean, their margins are widening, their loan yields are surging, and yet
their Q2 net income just dropped by over $1 million.
Right. And, here's why Wall Street might be severely mispricing this transition period. The messy headline numbers are kind of masking a coiled spring on the balance sheet.
Yeah, it's the classic trap, right? Taking headline earnings at face value. You look at that top line drop for Q2 2026, and you just assume the core engine is stalling out.
Which is what everyone does.
Exactly. But when you strip out the noise of their ongoing Olympic Bancorp merger, the underlying mechanics of this balance sheet are actually accelerating.
Wow.
Yeah, the real story isn't the dip in profit today. It's the structural cost savings and the asset repricing that's setting them up for the fourth quarter.
Well, welcome to the deep dive. Today, we are completely stripping down the July 2026 earnings print for Heritage Financial. Ticker symbol is HFWA.
A very interesting quarter to look at.
Super interesting. For those of you holding regional bank stocks or, looking for yield in this highly volatile macroeconomic environment, this specific quarter is honestly a masterclass.
Oh, absolutely.
It shows how chaotic a corporate transition can look on paper. But more importantly, it shows you exactly where to look for the actual value hiding underneath all those integration costs.
Because let's be real. We're operating in a banking climate where every single institution is fighting a ground war for deposit retention.
Right.
The cost of funding is basically the existential threat to regional banks right now. And Heritage is fighting that exact same war, but they're doing it while simultaneously trying to digest a massive acquisition.
Which is just a huge undertaking.
It really is. The friction from that dual mandate is exactly what created such a strange earnings report.
So let's get straight into the print. The algorithm feeders, those headline numbers that flash across your screen, they always focus on net income.
Right, the big shiny number.
Yeah. And Heritage reported $17.5 million for the second quarter of 2026, which translates to 42 cents per diluted share.
And that's a sequential drop, right?
Yep. Down from the $18.9 million they posted in Q1. So if you're just skimming the headlines, you see profit shrinking quarter over quarter, and you naturally assume the momentum is broken.
But, and this is why we do this, the very next line in their release completely subverts that narrative.
No, the margin data.
Exactly. They reported a net interest margin, or NIM, of 3.99%.
Wow.
Yeah, that is a 3 basis point increase from the prior quarter.
Mm-hmm.
And, this metric is literally the lifeblood of any commercial bank.
Because it's the spread, right? For anyone new to this, it represents the spread between what the bank earns on loans and investments versus, what they pay out to depositors.
Right. It's their actual markup.
Wow.
And we have to pause on that 3.99% figure because context is everything here.
It really is. In the middle of 2026, with the weird yield curve dynamics we're seeing.
And the intense competition for core deposits.
Yes. A bank operating near a 4% NIM is not just surviving. They possess some serious pricing power.
Oh, 100%. Most regional peers are fighting tooth and nail just to keep their margins above 3.9 or 3.20% right now.
Which makes 3.99 just massive.
It is. Operating effectively at a 4% margin means their asset side, so the commercial loans and securities, is throwing off enough yield to completely outpace the rising cost of their liabilities.
Okay, so what actually drove that?
Management explicitly noted it was driven by higher yields on their investment portfolio, plus a temporary dip in overall deposit costs.
Interesting.
And they're also finally getting the full quarter's benefit from the Olympic Bancorp merger assets, being fully integrated into the earning base.
Right, which sets up this massive fundamental contradiction.
Exactly.
If the core spread-like, the actual markup they are making on their money is expanding and sitting at an industry-leading level, how does the actual bottom line net income drop by $1.4 million?
That sounds broken.
It does. If the unit economics of the business are improving, the total profit should be rising. This is where I honestly start questioning if management is using the merger as a smokescreen for operational bloat.
And look, the skepticism is totally warranted. But you have to break down the non-interest expense line to see where the cash is actually bleeding out.
Okay, lay it out for me.
The core engine is running hotter and more efficiently, sure, but the structural cost of doing business was just dramatically inflated in Q2 by the Olympic integration.
Because integrating a legacy financial institution is incredibly capital intensive upfront.
Incredibly.
So looking at the actual ledger non-interest expense, which is, the overhead, salaries, technology, real estate, that shot up 13.7% to a massive $64.3 million for the quarter.
Which is a huge jump.
Right. You don't see a 13.7% sequential jump in overhead unless something major and structural is happening.
Well, the transcript isolates the culprit perfectly. Out of that $64.3 million, management explicitly flags $7.5 million purely in Olympic merger-related costs.
Oh, wow. Okay.
Yeah, so this isn't generalized inflation or some crazy wage pressure. This is the direct heavy lifting of corporate consolidation.
But wait, that $7.5 million is still a significant jump from the $5.2 million in merger costs they booked in the first quarter, right?
It is.
So we are looking at a bank spending roughly $7.5 million in a 90-day window just on logistics. What exactly is draining that much capital during a merger phase?
It's basically a combination of redundant human capital and incredibly rigid technology contracts.
Like having to pay for everything twice.
Exactly. When you acquire a bank, you inherit their core processing contracts, their software licenses, their data centers. You also inherit their entire back office staff.
Right.
So before the systems are officially merged, you are literally forced to run two parallel banks.
Man, that sounds so expensive.
It is. You're paying Fiserv or Jack Henry twice. You're paying two sets of compliance officers, two sets of loan servicers.
And I imagine severance is a big part of that, too.
A huge part. That $7.5 million includes the heavy severance payouts being negotiated for the overlapping staff who will eventually be let go, alongside all the consulting and legal fees required to just map the data migration.
So the critical takeaway here for anyone analyzing this stock is that these are largely finite transitional expenses.
Exactly. Very finite.
They are a massive drag on Q2 earnings. And as we will see in the guidance later, they will drag on Q3 as well.
Yeah.
But they do not represent the long-term operational run rate of the combined entity.
Right. They obscure the actual earning power. I mean, if you hypothetically add that $7.5 million back onto the bottom line, adjusting for taxes, the sequential narrative flips entirely.
It looks like a completely different bank.
Exactly. The bank is highly profitable, but they are essentially paying the toll required to build scale.
Makes sense. Let's shift from the income statement to the balance sheet, though, because the dynamics happening with their loan portfolio and deposit base are honestly just as messy and arguably more important for their forward-looking trajectory.
Oh, absolutely. The loan data specifically reveals a tremendous amount of churn in their local markets.
Right, because the headline number for the loan portfolio looks incredibly stagnant. Total loans receivable ended the quarter at $5.75 billion.
Yeah.
And that represents an increase of just $26 million, or roughly 0.4% from the prior quarter.
Which doesn't sound great.
No. I mean, in a vacuum, a 0.4% growth rate signals a bank that has completely pulled back on lending, or a market where credit demand has just cratered.
But the origination data contradicts that entirely. The commercial teams closed a staggering $339 million in new commercial loan commitments during the quarter.
Wait, $339 million?
Yes. That represents a 104% increase from their first quarter production.
Okay, so they originated over $333 million in new commercial debt. Yet the overall balance sheet barely expanded.
This is the definitive leaky bucket scenario. They are turning the spigot on full blast, pouring $339 million into the top of the bucket, but there is a massive hole at the bottom.
The payoffs.
Exactly. The earnings call details that loan prepayments and payoffs spiked to $152.4 million for the quarter.
So the capital is draining out almost as fast as they can deploy it.
Pretty much, yeah.
During the Q&A segment of the call, I remember an analyst challenged CEO Bryan McDonald on this exact dynamic. Like, how can you have record-breaking origination quarters without showing meaningful net loan growth?
And McDonald's response was actually highly illustrative of the current commercial credit cycle, specifically out there in the Pacific Northwest.
What did he say?
He pointed to two distinct drivers for the elevated payoffs, starting with a really heavy wave of construction loans reaching maturity.
Okay, this requires a bit of mechanical breakdown for our retail investors. How does a successful construction project actively shrink a bank's loan book?
Well, Heritage is heavily involved in commercial real estate construction. Right? So when a developer breaks ground on a new multifamily apartment complex or a retail center, Heritage funds the actual building process.
Okay, makes sense.
The developer draws on that loan incrementally over, say, 18 to 24 months. But a commercial bank like Heritage does not want to hold a 30-year mortgage on an apartment building.
Right, they aren't structured for that.
Exactly. They want short duration, floating rate exposure.
So once the building is completed, the drywall is up, and the developer secures tenants, the risk profile changes entirely.
Exactly. The property is now what they call stabilized. At that point, the developer takes that stabilized asset to the permanent financing market.
Like who?
Usually a massive life insurance company, a pension fund, or the commercial mortgage-backed securities market. Those entities issue a long-term fixed-rate loan to the developer.
And then the developer takes that fresh capital, hands it back to Heritage Financial, and pays off the construction loan in full.
You got it.
So the project is a total success. The bank managed the construction risk flawlessly, collected their interest and origination fees, and got their principal back. But structurally, a massive asset just evaporated from their balance sheet.
And in 2026, we are seeing the back end of a major construction boom that started a few years prior. All of those projects are hitting maturity simultaneously.
Which creates a massive headwind against net loan growth.
Exactly. The bank has to originate hundreds of millions of dollars just to replace the successful projects rolling off the books.
Wow. Okay, but McDonald also cited a secondary driver for the payoffs. Right. A noticeable uptick in clients selling their operating businesses.
Yeah, and this is a fascinating macroeconomic indicator. When a closely held commercial client decides to sell their manufacturing company or their logistics firm, the acquiring entity usually brings their own centralized banking relationship.
And their own capital stack.
Right. So the proceeds from the acquisition are used to clear the target company's existing debts. Heritage's commercial and industrial loans to that business get paid down to zero almost overnight.
Again, it is a phenomenal outcome for the business owner. It's the exact type of wealth creation a regional bank wants to foster in its community.
But from an asset liability management perspective,
it's a headache. It creates immediate liquidity that management now has to aggressively redeploy just to maintain their interest income.
Exactly. This explains why McDonald described the sales teams as being very, very active. The commercial bankers are essentially running on a treadmill set to a sprint just to stay in the same place.
It sounds exhausting.
It is. But the silver lining here, and this is honestly the absolute core of the bullish thesis for HFWA, is the pricing differential.
Right. The new rates.
Yes. The water they are pouring into the top of the bucket is vastly superior to the water draining out the bottom.
Let's talk about those rates, because the asset repricing cycle is acting as a massive tailwind. The earnings data shows that the average interest rate for new commercial loans originated in the second quarter was a robust 6.44%.
That's strong.
And the blended rate for all new loan originations across every category was 6.40%. Contrast that with the yield on the existing legacy loan portfolio.
Oh, this is the best part.
Yeah. The loans that are paying off, those older construction loans or business lines of credit, they were sitting at an average yield of just 5.72%.
So think about that math. Every single time a developer pays off a $10 million construction loan yielding roughly 5%, and the bank turns around and deploys that $10 million into a new commercial loan yielding 6.4%, they instantly expand their net interest margin.
Which is huge.
It's massive. They are manufacturing significant earnings growth without having to stretch their capital base or take on additional credit risk by artificially inflating the size of the loan book.
And McDonald explicitly labeled this a tailwind from asset repricing. This is the internal mechanism driving that 3.99% margin we talked about.
Exactly.
As long as interest rates remain elevated compared to the origination dates of the legacy portfolio, this churn, frustrating as it is for top-line growth metrics, is just quietly supercharging the earning power of the bank.
It is the absolute definition of balance sheet optimization. The portfolio is shedding lower yielding weight and replacing it with high octane assets.
Okay, so that covers the asset side of the ledger. But a bank's ability to originate those 6.4% loans is entirely dependent on their ability to fund them.
Right, the deposits.
Yeah, and if the loan portfolio is a leaky bucket, the deposit side of the balance sheet looks like management intentionally knocked the bucket over.
Yeah, the Q2 deposit metrics are pretty severe on first glance.
Very severe.
Okay.
Total deposits ended the quarter at $7.04 billion. That is a sequential contraction of $209.8 million, representing a 2.9% drop in just 3 months.
And in the post-2023 banking environment, when retail investors see a regional bank bleed over $200 million in deposits in a single quarter,
they panic.
Exactly. The immediate assumption is systemic stress. The market has been conditioned to equate deposit outflows with a bank run.
Assuming customers are just fleeing to the safety of the money center behemoths or, chasing higher yields and sovereign debt.
And that market PTSD regarding deposit flight is very real, which is precisely why Chief Financial Officer Don Hinson aggressively front-ran the narrative on the earnings call.
He had to.
He really did. He spent a significant portion of his prepared remarks deconstructing that $209 million outflow line by line.
And when you analyze the underlying mechanics, it becomes clear this was not a panic-driven capital flight.
No, not at all.
It was a mixture of standard commercial seasonality, a highly specific transactional event, and just ruthless margin management by the executive team.
So let's pull apart those three components, right? Starting with the seasonality. Hinson pointed directly to Q2 tax payments.
Right, because Heritage is a commercially focused bank. Their deposit base is heavily weighted toward operating businesses rather than retail checking accounts.
And the second quarter encompasses April, which is obviously the heaviest tax remittance period of the year.
So businesses spend the first quarter hoarding cash in their operating accounts, and then in April, they just initiate massive wire transfers to the U.S. Treasury.
Exactly. It is a totally predictable, annualized drain on liquidity. The bank models for this outflow months in advance.
So it reduces total deposits, but it has literally nothing to do with client attrition or dissatisfaction.
Nothing at all.
Okay, so the second component is the one that triggered the most scrutiny from the analysts. The transcript specifically identifies a single $67 million relationship withdrawal.
Oof, that's a big number.
Yeah, having one client yank $67 million out of the bank is a terrifying data point if you don't know the context.
But Hinz diffused the anxiety around this figure by explaining the life cycle of that specific deposit.
What did he say?
Well, this was not a legacy relationship pulling their operational funds. The client had deposited the $67 million on a strictly short-term basis during the first quarter, with the explicit pre-communicated intention of deploying it in the second quarter.
Ah, so it was institutional hot money.
Precisely. We see this constantly in commercial banking. A client might close a massive real estate divestiture or raise a private equity round, and they just need a secure depository to park the liquidity for 60 to 90 days before executing their next transaction.
Got it. So Heritage secured the funds, held them for the agreed upon duration, and the client withdrew them exactly on schedule.
Right. The bank provided a temporary service, likely at a highly negotiated rate.
But it inflated the Q1 deposit baseline artificially.
Exactly, making the Q2 normalized outflow look like a systemic loss when it wasn't. It was just the mechanical completion of the transaction, not a fractured client relationship.
Okay, that makes a lot of sense. The third component driving the deposit drop is where we see management actively steering the ship rather than just reacting to the market.
This is the interesting part.
Yeah. The transcript reveals they intentionally allowed $48.5 million in brokered CDs to run off the balance sheet during the quarter.
Right.
And we need to distinguish between core deposits and broker deposits here, because abandoning $48 million in funding is a massive strategic decision.
It really is. Yeah. So core deposits are the holy grail of regional banking. That is a local business operating its payroll out of Heritage, or a retail client walking into a physical branch and opening a savings account.
Right.
Those deposits are incredibly stable, highly relational, and historically very cheap.
But brokered deposits are the complete opposite.
Total opposite. Brokered CDs are purely transactional wholesale funding. If a bank needs liquidity instantly, perhaps to fund a massive spike in commercial loan demand, they don't wait for local foot traffic.
Right. They go to Wall Street.
Basically. They go to a national financial brokerage, like a Morgan Stanley, and request a $50 million block of funding.
And the broker chops that request up into small certificates of deposit sells them to yield-hungry investors nationwide and wires the $50 million to the bank.
Exactly. The problem, though, is the cost.
Because the bank pays a premium yield to those national investors, plus a significant fee to the broker for facilitating the transaction.
Yep. It is fast, easy liquidity, but it compresses the net interest margin severely.
So in the second quarter, as 48.5 million of these expensive brokered CDs hit maturity, Heritage's treasury management team looked at the prevailing rate environment and simply refused to renew them.
They just let the funding walk out the door.
They executed a pricing arbitrage, right? Hinson noted that alternative borrowing rates had become more attractive than the brokered CD market.
Yeah, so to replace the liquidity lost from the tax payments, the $67 million withdrawal, and the $48 million in abandoned brokered CDs, the balance sheet shows total borrowings increasing to $166.3 million.
And this is primarily executed through Federal Home Loan Bank, or FHLB, advances.
Which is a highly calculated maneuver. The Federal Home Loan Bank provides secured wholesale lending to member banks.
Okay.
So Heritage pledges some of their high-quality commercial real estate loans or securities as collateral, and the FHLB extends them cash at a very competitive rate.
Oh, nice. By transitioning the liability structure away from premium-priced brokered CDs and into secured FHLB advances, management successfully lowered their marginal cost of funds.
It makes the headline total deposits number look anemic,
Right.
which, scares the casual retail investor. But a sophisticated analyst recognizes this as ruthless, effective margin protection.
They are intentionally shrinking the balance sheet to improve the underlying profitability.
Exactly.
And this philosophy of taking a short-term optical hit to generate long-term structural yield is everywhere in this specific earnings call. You see it again in how they manage the investment portfolio.
Oh, the bond swaps.
Yes. The transcript details a strategic repositioning where management sold off $38 million in securities. But they executed the sale at a loss of $217,000. Why would a highly profitable bank intentionally realize a capital loss on their bond portfolio?
Well, this is a classic asset liability management tactic known as a loss trade or a bond swap, and it is entirely driven by the math of the current yield curve.
Walk us through it.
Okay, let's assume Heritage got those $38 million in bonds back in, say, 2021 when interest rates were pinned to the floor. Those bonds might be paying a fixed coupon of 2%.
But in the 2026 rate environment, where risk-free government debt is yielding significantly higher, a 2% bond is a severely impaired asset.
It is technically underwater. If Heritage holds that bond to its final maturity date, they will eventually receive the full $38 million principal back. However, they are trapping that capital in a low-yielding vehicle.
Suffering a massive opportunity cost every single month.
Exactly. Because no rational investor would pay full face value for a 2% bond today when they could buy a newly issued 5% bond.
Right. So the market value of that bond has dropped, and Heritage's management decided the opportunity cost was too severe.
Yep. They chose to sell the $38 million block of securities at the current discounted market value, forcing them to recognize that $217,000 loss on the Q2 income statement.
So they absorb the pain today.
They take the capital hit, but then they immediately redeploy the proceeds from that sale into newly issued higher yielding assets, perhaps securities paying 5.5 or 6%.
And the spread between the old 2% yield and the new 6% yield is so wide that the incremental interest income generated by the new bonds will rapidly earn back the $217,000 capital loss.
The earn-back period on these trades is typically modeled at 18 to 24 months. After that break-even horizon is crossed, the higher yield drops directly to the bottom line.
Permanently elevating the net interest margin.
Exactly.
And the strategy is undeniably working. The earnings release confirms that the overall yield on their investment portfolio increased by 11 basis points sequentially during the second quarter.
When you combine the bond portfolio repositioning with the intentional runoff of brokered CDs and the massive asset repricing on the commercial loan side, a very clear narrative emerges.
Management is not just sitting on their hands waiting for the Federal Reserve to save them.
No, they are aggressively scrubbing and optimizing every line item on the balance sheet.
Which perfectly sets up the most critical phase of our analysis. Management guidance.
Future state.
Yeah. We've established that Q2 was messy, but fundamentally strategic. The balance sheet is optimized, but those Olympic merger costs are still a massive anchor on profitability. So what exactly is management projecting for the back half of 2026?
This is where the thesis for Heritage Financial is either validated or destroyed. The forward guidance dictates how Wall Street models the stock price.
Right.
You have to carefully weigh their projections regarding the dual forces acting on the bank. So the impending drop in operating expenses versus the escalating cost of retaining deposits.
Let's start with the expense line, because CFO Don Hinson painted a very stark picture of what is coming. We know Q2 non-interest expenses were elevated at $64.3 million.
And Hinson was aggressively transparent. that Q3 will offer no relief.
Yeah.
He guided for Q3 expenses to remain right in that elevated $64 to $65 million range.
Because the third quarter will be the peak of the integration friction. They are finalizing the technical architecture, finalizing the severance payouts, all of it.
But then he issues a massive pivot. Hinson projects that in the fourth quarter, expenses will fall off an absolute cliff.
Down to a normalized run rate of $56 to $57 million.
Yeah, that implies an $8 million reduction in quarterly operating expenses.
Oh.
If you annualize that figure, you are looking at $32 million in structural cost savings flowing directly into pre-tax income starting in Q4.
Okay, as an analyst, this is where I have to push back hard.
Go for it.
An $8 million overnight reduction in operating expenses sounds fantastic in a PowerPoint presentation, but execution risk is very, very real.
It definitely is.
They are relying on a massive technology migration, a core systems conversion scheduled for late September to unlock these savings. I have covered enough bank mergers to know that flipping the switch on a new core processor is rarely clean.
And your skepticism aligns perfectly with the institutional analysts on the call. An analyst from Piper Sandler specifically zeroed in on this projection, demanding clarity on the certainty of that core run rate.
Right, because if the data mapping fails, or if, middle market commercial clients experience routing errors on Monday morning because the API didn't integrate properly, Heritage will be forced to retain legacy staff and legacy systems for months to triage the damage.
And that $8 million in savings gets pushed to 2027.
Exactly, and the stock gets hammered.
Well, a botched core conversion is indeed a regional bank's worst nightmare. However, Hinson's confidence in the $56 to $57 million target is rooted in the binary nature of the contracts they hold.
Explain that.
A systems conversion isn't just an IT upgrade, it's a contractual guillotine.
Walk me through the mechanics of that weekend in September.
Right now, Heritage is paying for two entirely separate technological ecosystems. They pay vendor fees for the legacy Olympic core processor, and they pay for the legacy Heritage processor.
That's expensive.
They maintain separate data centers, separate digital banking platforms, and separate cybersecurity monitoring contracts.
And furthermore, they have specialized back office staff who only know how to operate the old Olympic system, working alongside Heritage's legacy staff.
Right. But the moment the final customer data file is mapped and migrated over that weekend in late September, the Olympic system is permanently decommissioned.
Boom, done.
The master contracts with those legacy vendors are legally terminated.
The software licenses expire instantly.
The data center leases end. The duplicate back office staff who have been operating under retention bonuses specifically tied to the conversion date are officially transitioned out of the company.
That's a huge cut.
Hinson explicitly stated that by Q4, the actual merger-related expenses, which remember consumed $7.5 million in Q2, will be virtually eliminated, reduced to just small, minor things.
So the economies of scale they promised when they announced the Olympic acquisition are finally mathematically realized. You are running a significantly larger asset base over a single, unified, fixed-cost infrastructure.
Yep. If they execute the technical migration without critical failure, the math is undeniable. That $32 million in annualized savings is a massive tailwind.
But no bank operates in a vacuum, right? And this expense tailwind is going to collide directly with a macroeconomic headwind.
The deposits.
We have to scrutinize Hinson's commentary on the deposit market. The CFO made a really sobering admission regarding their cost of funds, explicitly stating, "I think we hit the bottom."
Ouch. For a bank CFO, declaring that deposit costs have bottomed is a stark acknowledgement of market reality.
Yeah, he is confirming that the era of relying on cheap, sticky, zero-interest deposits is officially over.
Right. He noted that their interest-bearing deposit cost ended the quarter at a spot rate of 1.64%. And despite the Federal Reserve holding the macro policy rate steady, Hinson admitted that local competition for CDs and high-yield savings accounts is forcing that number higher.
Because the retail and commercial depositor base has fundamentally reawakened to yield. I mean, for nearly a decade, clients left massive cash balances in checking accounts earning 0.01% because alternative risk-free assets offered practically zero return.
There was no opportunity cost.
Exactly. But when a client can log into a brokerage app and buy a 3-month treasury bill yielding 5%, or part cash in a money market fund yielding 5%, the friction required to move their money is suddenly highly justifiable.
And this is the concept of deposit beta playing out in real time. If Heritage wants to defend their balance sheet, if they want to prevent their core commercial clients from sweeping excess cash into Vanguard or Fidelity, they are forced to pay up.
CEO Bryan McDonald corroborated this pressure too. He explained that while their strategy is to capture the primary operating relationship, meaning they process the client's payroll, vendor payments, and daily cash flow, they are increasingly forced to offer premium rates on the client's excess liquidity just to keep the entire relationship in-house.
Which means the net interest margin, despite sitting at a lofty 3.99%, will be under intense pressure in the back half of the year.
A battle on two fronts.
Exactly. They must continually push their commercial loan yields higher through that repricing dynamic we discussed, just to outpace the escalating cost of retaining their own deposits.
So we have a definitive $8 million expense drop coming in Q4, fighting against a gradual, grinding increase in deposit costs. How does management project their growth trajectory amidst those conflicting forces?
They are projecting operational leverage. They believe the structural cost savings and the high yield on new loan originations will allow them to absorb higher deposit costs while continuing to expand the business.
Did they give numbers?
Yeah, but McDonald issued guidance for annualized loan growth in the mid-single-digit range for the second half of 2026.
Mid-single digits implies a fairly conservative 4% to 6% annualized growth rate.
Right. They are not trying to double the size of the bank. They are targeting methodical, high-quality credit expansion.
And to fund that 4% to 6% loan growth, they need a corresponding expansion in deposits.
Which is tricky right now. When challenged by a Stephens Inc. analyst on their ability to match fund that loan demand without resorting to expensive wholesale borrowings, Hinson remained pretty confident.
Why?
He noted that the third and fourth quarters historically provide strong seasonal deposit inflows for Heritage, and he projected deposit growth to basically mirror loan growth in the mid-single digits.
So they are managing a perfectly synchronized balance sheet expansion. If they can execute that mid-single digit growth on both sides of the ledger, running over the newly unified, low-cost Olympic technology stack, the return on average assets will surge.
It is a fundamentally sound conservative growth strategy.
Well, we have dissected the headline contradictions, the leaky loan buckets, the strategic bond swaps, and the impending expense cliff.
We've covered a lot.
It is time to synthesize this data. We need to deliver a clear verdict on the viability of this specific equity for the retail investor. Analyzing the totality of the Q2 earnings print and the forward guidance, the stance we have to take is cautiously bullish for the long-term income-focused shareholder.
I agree. The data heavily supports a cautiously bullish thesis. The cautious modifier is strictly tied to the near-term execution risk, though.
Because Q3 is going to be rough.
The third quarter is guaranteed to look messy. Non-interest expenses will remain highly elevated. The technical systems conversion in September carries inherent operational risk, and the cost of deposits will continue to creep higher.
So if you were trading short-term options, Q3 is a minefield.
Yeah, don't do that.
But if you're a long-term investor, the bullish core of the thesis is rooted in the pristine quality of the underlying assets. We have to talk about their credit metrics because they are almost suspiciously flawless.
The credit quality is the ultimate safety net for this stock. Chief Credit Officer Tony Chalfant delivered a masterclass report on the health of their loan book.
Give me the numbers.
Net charge-offs, which represents the actual realized capital the bank loses when a borrower defaults and the collateral is liquidated, were just $234,000 for the entire second quarter.
Okay, let's contextualize that number. They are managing a $5.75 billion commercial loan portfolio, operating in a high interest rate environment that is actively stressing commercial real estate, and their total realized losses for a 90-day period were less than $250,000.
It's crazy. That equates to an annualized net charge-off rate of 0.03%.
Wow.
In commercial banking, a metric that low is effectively a rounding error. It implies virtually zero distress in the borrower base.
Furthermore, their forward-looking risk indicators are actually improving. Non-performing assets, which are loans that are severely delinquent but haven't yet been officially written off, remain incredibly stable at a microscopic 0.19% of total assets.
And the ratio of substandard loans actually dropped sequentially from 2.1% down to 1.8%.
Because the credit quality is so robust and the historical loss rates remain so suppressed, management executed a highly aggressive accounting maneuver. They lowered their allowance for credit losses, or the ACL.
And the ACL is the most important reserve pool in banking. It is the rainy day fund.
Right. Under the current expected credit losses methodology, or CECL, banks are required to forecast future economic distress and set aside capital today to cover potential future defaults.
So funding that reserve pool directly impacts the income statement. When a bank expects economic turbulence, they take a provision expense, pulling capital out of their quarterly earnings and stuffing it into the ACL.
But Heritage went the exact opposite direction. Because their portfolio is performing so flawlessly, they determined they had too much capital trapped in the reserve. The ACL ratio dropped from 1.06% of total loans down to 1.03%.
They executed a reversal of provision for credit losses, funneling nearly $1 million out of the reserve pool and pushing it back into net income.
That is not an accounting trick. It is a massive, tangible vote of confidence by the chief credit officer in the strict underwriting standards at the bank.
And that internal confidence is clearly permeating the boardroom, which brings us to the final pillar of the bullish thesis: capital return.
Let's hear it.
While the market is obsessing over the Q2 net income drop, management is aggressively utilizing their excess capital to reward shareholders.
Right. The transcript confirms they repurchased 372,000 shares of their own common stock for roughly $10 million during the quarter.
When a bank management team authorizes stock buybacks during a highly expensive merger integration, it sends a definitive signal to Wall Street.
What's the signal?
They are looking at their internal projections, analyzing that massive $8 million expense drop coming in Q4, and concluding that the public market is fundamentally undervaluing their equity.
They are essentially stating that the highest yielding asset they can buy right now is their own stock, and they still retain authorization to repurchase another 424,000 shares in the open market.
Combine the buybacks with the dividend policy. They raised the quarterly cash dividend to 25 cents per share, representing a 4.2% sequential increase.
So the entire picture snaps into focus. You have an institution producing pristine credit metrics, executing strategic balance sheet optimization that is expanding their net interest margin, tracking toward a massive structural cost reduction in the fourth quarter, and actively returning capital to shareholders through elevated dividends and buybacks.
If you are holding HFWA, Q3 is going to require patience. The headline numbers will likely remain noisy.
For sure.
The real metric to watch isn't the Q3 expense line, it is the late September PR wire. If management announces a successful, smooth execution of the Olympic Bancorp core systems conversion, that is your definitive signal.
The structural dread is gone, and Q4 is poised to showcase the true earning power of the combined institution.
It is the textbook definition of enduring short-term optical pain to secure long-term structural dominance in their regional footprint.
However, we cannot close this analysis by simply cheerleading the bull case. As investors, our job is to relentlessly hunt for the structural cracks that could derail the thesis.
Always.
And while management has constructed a highly optimized engine, the banking sector is inextricably bound to the macroeconomic weather. There is one specific data point buried in this transcript that serves as a glaring neon warning sign if the economy in the Pacific Northwest suddenly contracts.
You are targeting their extreme concentration in commercial real estate lending.
Yes, I am. The transcript casually notes that Heritage maintains a commercial real estate, or CRE, loan concentration of nearly 300% of their total risk-based capital.
Wow. And to understand the gravity of that metric, we have to look at the regulatory framework. Total risk-based capital is the ultimate safety net. It is the shareholders' equity designed to absorb catastrophic losses before the bank becomes insolvent.
So if a bank has $100 million in total capital, a 300% CRE concentration means they have extended $300 million in loans backed by commercial properties, office towers, retail strip centers, industrial warehouses, multifamily complexes.
And the FDIC and the Federal Reserve pay incredibly close attention to this specific metric. In fact, regulatory guidance historically uses a 300% CRE to capital ratio as a major tripwire.
Really?
Yeah, when a bank crosses that threshold, examiners descend. It signifies that the institution lacks diversification and is highly vulnerable to a shock in one specific sector of the economy.
And commercial real estate is the most heavily scrutinized, highly volatile sector in the global economy right now. We are witnessing a secular shift in how office space and retail real estate are utilized post-2020.
Now, to be perfectly objective, Chief Credit Officer Tony Chalfant did not hide from this metric on the call. He addressed the 300% concentration directly.
What was his defense?
He stated that the risk profile within their specific portfolio is highly manageable. He argued that their underwriting standards insulate them from the broader national panic regarding commercial real estate, specifically citing that their properties are navigating localized economic headwinds effectively.
Okay, so it's a regional defense.
Right. He also provided a technical defense, noting that the 300% ratio was artificially and temporarily elevated due to the fair value accounting marks required by the Olympic Bancorp acquisition.
Ah, the merger math again?
Yep. Management fully expects the concentration ratio to naturally drift downward toward their historical pre-merger levels as they organically grow capital and amortize the portfolio over time.
And honestly, the empirical data entirely supports his defense. We just analyzed the numbers, a 0.03% charge-off rate and a reduction in the credit loss reserve. The underwriting has, up to this exact moment, been flawless. But as an investor, you have to weigh the margin of error.
The diagnostic snapshot shows an engine running perfectly inside the garage, under highly controlled, stable conditions. But a 300% CRE concentration means you are taking that engine off-road with highly combustible fuel.
That's a great way to put it. If the macroeconomic weather fundamentally shifts, if those manageable, localized headwinds in the Pacific Northwest mutate into a localized recession, driving up unemployment and devastating commercial rent collection, the margin of error just evaporates.
It does.
If the underlying collateral values of those office buildings and retail centers drop by 30%, will that pristine 0.03% charge-off rate hold up?
A heavily concentrated portfolio can transition from a highly profitable yield generator to an existential threat very rapidly during a liquidity crisis.
Exactly. Buying this stock requires an investor to possess absolute faith not just in Heritage's current underwriting models, but in the sustained multi-year economic resilience of their specific geographic footprint.
It is a brilliantly optimized institution, but it is heavily tethered to a single asset class.
So keep that concentration risk in mind as you watch the tickers. When you see a messy top-line headline, remember to look under the hood. Look for the expense cliffs, the asset repricing, and the credit metrics.
Look past the noise.
Right. In commercial banking, the Q2 print only tells you the cost of the journey. It doesn't promise where the road is ultimately going. Keep digging, keep pulling apart the transcripts, and we will catch you on the next deep dive.